Thinking about buying a home because you believe interest rates are going to drop and all of a sudden it's going to become a lot more affordable? Well, you might want to think again. In this video, we're going to discuss why the popular advice to marry the property and date the rate could actually be setting you up for financial disaster. Please don't fall for the worst real estate advice ever. Stay tuned and find out why. Over the last couple of years, we've seen interest rates go from the mid 2% range upwards of 8%. And during this climb in interest rates, we've heard a lot of people out there with the advice that you should marry the property and date the rate. So what exactly does that mean? That means that you as a potential home buyer out there should go find the perfect property that you want to live in and not worry about the interest rate at all, because at some point in the future, interest rates are going to come back down and that property is all of a sudden going to become a lot more affordable. Now, I don't know about you, but one of the dates that I had ended up becoming my wife. So I ended up marrying it. And because of that, it's never changed. So what happens if you buy a home now and you're dating the rate and that interest rate never gets any better? Are you still in a position to afford that home? And that's really what I want to talk about in today's video. I do want to address the idea of interest rates coming down because I personally believe that is going to happen. But outside of interest rates coming down, there are some other things that you have to take into account to make sure that you're actually in a position to refinance and take advantage of that new rate if and when it presents itself. But before we do that, I'd like to take a minute and ask a favor. If you find any value in my videos at all, do me a favor and hit that thumbs up. And if you like the content that I do and support the work I do here on YouTube, do me a favor and subscribe to the channel. So for the better part of 2 years, I've been on the internet, on my YouTube channel, preaching the idea that interest rates should be coming down, that interest rates should moderate because of everything out there happening in the economy. And during this same period of time, interest rates not only didn't go down, they actually went up. And the primary reason for that is because inflation has stayed higher for longer. Unemployment has actually been better than expected, while at the same time, the Federal Reserve has remained super hawkish on their stance, more or less saying that interest rates should stay higher for longer. And because of this, there's a lot of people out there that got interest rates a year and a half ago when interest rates were at the peak, 7.5% to 8%, that are now stuck with that rate, at least in the interim, because haven't moved back like a lot of people thought they would, and therefore setting up really bad advice to marry the property and date the rate. But with that, I do want to be optimistic because I do believe interest rates are going to moderate. Interest rates are going to come down. But interest rates are only going to come down as the economy continues to soften. So what do I actually mean by soften? Well, we're likely going to see unemployment rise. In addition to that, we're likely to see some uncertainty when it comes to the global economy. And as those things start to happen, the Fed is likely going to ease on the Fed funds rate, which in turn is going to ease the spread between the 10-year and the 30-year and allow interest rates to come down. And because of that, you're likely to see interest rates move lower. But that's where you need to be careful. Just because interest rates come down doesn't mean you're now in a position to take advantage of them. And that's really important and something that needs to be pointed out when giving this advice of marrying the property and dating the rate. Just because interest rates come down doesn't mean you, as a homeowner, are now in a position to take advantage of those rates. And one of the primary reasons for that is because what happens if you were a buyer and you came in with a minimal down payment? You only put 3.5% down at a time when the market was hot, competition was really hot, inventory was low, buyer demand was crazy, and you went in and bid top dollar for a property in that market. But since then, inventory has started to increase. Maybe it's not a full buyer's market, but inventory levels have started to creep back up to where they were in 2019. So home prices have moderated since that peak when you bought that property. And let's say, for example, that home prices haven't really pulled back, but they've more or less stayed the same from when you've purchased that home. So yes, you've paid down the principal in that property a little bit since you've owned it, but remember, you only put a minimal down payment when you purchased that home. So now when you go to refinance, they're going to do an appraisal on that property. Now, what if the appraisal comes in at the same price that you purchased your home at, or maybe even slightly less in some cases where inventory has really increased. Are you now in a position to still refinance and take advantage of that lower rate? Or are you in a position where you have to keep that rate longer because you don't have the equity in your property? Or in some cases, let's say maybe your credit score has dropped during the period since you got your loan, or that you've had to change jobs. Maybe you got laid off and you had to take another job and you're not making the same income that you were making earlier. Do you still qualify for the same loan in order to be able to refinance? And that's really what I want to stress here. Just because interest rates come down doesn't mean you're going to be able to take advantage of them. You still need financial stability. You still need to be able to provide documentation that shows that you qualify for that mortgage, that you can actually meet their guidelines to be able to take advantage of that lower rate. And while I don't personally believe a housing crash is coming or anywhere near that, I do believe that as the economy softens, you are going to have more and more people lose their jobs. You're going to have more and more people have to change jobs. And in some cases, people are going to have to max credit cards in order to make things work, which means it's going to affect their credit score, in turn putting people in a different financial position than when they originally got their loan. So as I always preach in all of my videos, you should not be buying a home with the expectation that something has to change in order to make that home more affordable. If you cannot afford that home now, you shouldn't be purchasing that home. You should sit on the sidelines and wait until your circumstances change to make that home more affordable. At the same time, you shouldn't be buying a home unless you have money in the bank as well and you're comfortable with the payment. As I always say, you might not like the payment right now because interest rates are high, but you have to be comfortable knowing that you can make that payment every single month if that payment never changes. If that's the best it gets, then you have to be comfortable with it. And on top of that, you need to have that longer term time horizon that we always talk about. And the main reason for that is so that you can avoid the ebbs and flows of the real estate market. Real estate doesn't go up every year, surprisingly, even though a lot of people that purchased in the last couple of years believe that to be the case. Because so much equity has been gained in such a short period of time, people have very short memories. They forget that on average, real estate has only actually gone up around 4.6% per year over the last 65 years. That this 40+% of appreciation that we've received in the last couple of years isn't normal. And you shouldn't be buying a home with the expectation that that's what you're going to get going forward. So instead of following the worst advice ever of marrying the property and dating the rate, instead you should follow the advice of marrying the property and being completely comfortable with the payment where it is right now. Because in some cases, even if interest rates drop, it doesn't make sense to refinance. If you're wondering what I'm talking about, do me a favor and check out this video here.